Hello traders and welcome back to my YouTube channel. In this video, we're going to be breaking down 5 reasons why traders are failing in 2023. Now, before I got to where I am today, I did have to go through some hard times. It actually took me about 2 years to be profitable. However, I didn't have any help and it was all self-taught. Looking back, there's definitely ways I could have shortened that time it took me to get profitable. And that's what I'm going to be sharing with you in this video. Before we get into the video, make sure to subscribe to the channel and follow me on Instagram, Analysis, where you'll see my day in, day out trading journey. But for now, let's get straight into it. So, as explained, we're going to be breaking down 5 reasons why traders are failing in 2023. The first reason, analysis paralysis. So what is analysis paralysis and how to avoid it? Analysis paralysis basically looks like this. And it's when traders clog up their screens with chart patterns, indicators, support and resistance, trend lines, and just too much of it basically, overcrowding their screen. I've been victim of this myself, and the reason traders do it is because they feel like the more analysis that they do on their chart, the better their trade is going to be. But unfortunately, this is not true. No matter what, there's always going to be a reason not to enter a trade. You're going to find a resistance level, a support level, a trend line, a candlestick pattern, whatever it is, there's going to be someone out there with a reason to not enter that trade. Realistically, nobody knows 100% what is going to happen next in the market. We all have our slight edge, which we trust over a long period of time. By clogging up your screen with all this different type of analysis, trend lines, resistance levels, etc., you're only going to decrease your ability to make an informed and calculated decision within the market. So how can we avoid it? Keep it simple. It's as easy as that. If you're clogging up your charts with all this different type of analysis, trend lines, support levels, etc., you're only going to confuse yourself, which is then going to make it hard for you to make a calculated, informed decision later on down the line within your trading. In my opinion, by having a clearer chart, your trading will actually improve. And this is because the more simple your chart is, the easier it is to identify your edge within the market. And then with this, you're then able to clearly enter trades based on your analysis. Number 2, strategy jumping. So what is strategy jumping and how to avoid it? So how many of you are trading and you're testing a strategy and you do it for a week and it doesn't work out, so then you jump to the next one, and then that doesn't work out, so you jump to the next one and the next one, and you end up going around in this vicious cycle of different strategies, and you're just asking yourself what is going wrong. Once again, I was victim to this, but what I realized was it wasn't the strategies that were wrong, it was myself as a trader. And what I learned was the consistency that I was seeking wasn't within the strategies, it was within myself. And what eventually happened, which was a major turning point within my trading career, is that I realized there's 1,000 different ways to trade and 1,000 different strategies, but there's only one trading mindset. What you need to be doing is finding a strategy that suits your personality, that suits you as a person. Let me give you a personal example. So myself, I'm a day trader, which means I'm in and out of trades within the day. As a swing trader, you're potentially holding trades for maybe 2 to 3 days. So why did I personally decide to do day trading over swing trading? It's not because day trading is better. I know plenty of swing traders that are profitable, but I just chose it because of my own personal preference. As a swing trader, there's a possibility that you could be holding trades for a couple of days, meaning there's a possibility that you could wake up in the morning and your trade has hit stop loss. Now, me as a trader, I do not want to start my day like that. By being a day trader, I'm in and out within the day. I then close my positions. I then enjoy my evening. I then wake up in the morning, go to the gym, have breakfast, and then I attack the day again with a fresh mindset. But by being a swing trader, you're potentially holding that trade, and it can potentially be in the back of your mind for a couple of days. However, some people can cope with it, some people can't. And like I said, your strategy needs to be unique to yourself. Another thing you need to be doing once you have your strategy is making sure you're testing it over a long period of time. Your strategy isn't reliable over days and weeks. You need to be testing it over months and years in order for you to understand whether that strategy is profitable before then potentially moving on to another one. Okay, next we have following the crowd. So what is following the crowd and how to avoid it? Following the crowd, simply put, is trying to be like everybody else, whether that's trying to be in multiple trading groups or just copying people on Instagram. That is what I mean by following the crowd. And in an industry where if you look up the stats and 95% of people in this industry are losing money, trust me, you don't want to be following the crowd. By being in multiple trading groups, following people on YouTube and following loads of people on Instagram, etc., you're going to end up confusing yourself. For example, I see it all the time and I've been a victim of this myself. You think by getting clarity and opinions of others, you think your analysis is going to be stronger. For example, you put your analysis in a group and you're asking for many opinions. No matter what, someone is going to have an opposite opinion to you. What I mean by that is you post analysis in one group is going to say, yes, they agree with it. You post it in another, that group is going to say, no, they don't agree with it. So then you're left confused. What do? Do you copy what that group says, or do you copy what that group says? Do you copy what that trader says? No matter what, it's going to be conflicting. You're going to have different opinions. And ultimately, what this will lead to is you not trusting your own analysis. And going back to the point of how 95% of traders are losing in this industry, it just goes to show that being unique is actually a good thing. If people don't understand why you're entering that trade or why your analysis is like this, take it as a compliment. So the fourth one is incorrect journaling. So what is incorrect journaling and how to avoid it? So we all know that journaling your trades is an important aspect of successful trading, but are you doing it correctly? Most people will just journal their trades, their entries, their exits, how the trade played out, how many pips they caught, their percentage risk, their lot size, all the statistical stuff, but it's a lot more than that. When you're journaling, you need to be journaling your thoughts and feelings on that specific trade. So why am I saying this? In my opinion, trading is like 90% psychology and mindset, which means you need to have a great understanding of your own personal thoughts and feelings throughout that day when you're trading. More specifically, you need to be journaling things like how many hours of sleep did you get the night before? What did you have for breakfast? Did you go to the gym and how long for? How you felt when you entered the trade? How you felt when you exited the position? Your thought process throughout. How often was you looking at the chart? How often was you getting your phone out to look at MetaTrader 4 to look at the profit or the loss? Where was you when you entered the trade? Was you in bed? Had you just woken up? Was it just before you went to bed? Was you driving? Did you have to pull over? Was you at the gym? Was you at the office? All these little aspects of your day-to-day life really play a key component in your trading ability. And remember, how can you be consistent in your trading if you're not consistent in yourself and in your day-to-day life? The final point I want to talk about is trying to run before you can walk. So, what is running before you can walk and how to avoid it? In an industry with endless opportunities and unlimited potential, it can be easy to get tempted into trying to reach that top spot before you go through those necessary lower steps that is needed in a trader's journey to get to that end goal. Now let's talk about this in a bit more detail, and I'm going to use funded accounts as an example. So don't get me wrong, funded accounts are a brilliant opportunity for traders and if done correctly, can be very rewarding. In this day and age, traders seem to be going for a funded account way too soon than they should be. What I mean by this is traders seem to just be having a couple good weeks in the market and then they think this is enough to then go for a funded account. In my opinion, a trader's journey should go as followed. They should trade a demo account, then they should trade a small live account, then they should trade a larger live account, and then once they found consistency there, they should then be attempting a funded account. The reason being is purely for psychological reasons. To begin with, traders should be testing their strategy on a demo account. Next, they move on to a live account with small amounts of capital that they can afford to lose to test their psychology in the market for what it's like to trade risking their own capital. At this stage, traders will then begin to see how their strategy is affected by trading with real capital. Remember, you should be doing this for a prolonged period of time of at least 3 months, where you can really test your psychology in the market over a long period of time to see if it's sustainable enough. Remember, your performance on your live account will not be directly reflected on your funded account because of the limitations, so be prepared for that to happen. Remember, always consider the risks before the rewards and always identify the worst case scenarios. A lot of you are thinking that once you get that funded account, your life's going to change. But remember, getting the funded account is one thing, but maintaining that account is another. You have to have a clear management plan for that funded account. And even in the case of worst case scenarios, understand that losing months can happen, losing streaks can happen. So that account is not guaranteed to always be in your hands. So with all that being said, I'm going to leave a link in the description to our free Discord server. In this free server, we go live once per week, breaking down the charts for all our members. Right guys, so that's the end of the video. If you enjoyed it, make sure to leave a like and a comment. Let me know how it went in the comment section below. I hope you all have an amazing day, but for now, take care.